Hey traders, this is Christian from Trebek at Trade Group, and today is Monday, April 1st, and I'm doing just a quick video on a way that you could trade Amazon short-term options, but doing it a little bit different. So first things first, we were talking about, I was trying to give an explanation today on private Twitter about how you can trade Amazon a little bit differently. It's something that I've been experimenting with the last couple weeks, and it's been working pretty well. And I haven't been doing it with any major size, because always when you want to try a new strategy out or something that you haven't, a strategy that you haven't revisited in a while, you kind of want to just keep it small and then just start to, experiment a little bit with the trade and then kind of go from there. But so there's a reason why I'm looking to do it this way. So what have we been seeing the last couple of weeks in terms of Amazon option activity? Well, I would say over the last month, and this goes back to when I was on vacation, we were trading some call spread in Amazon, but it's mainly because we've been seeing some really short-dated calls that are going up in Amazon. And what's nice about them is they're going up really aggressive. They're being swept. And they're either going, like, so today is Monday, you have all this week, and you have next week. So they're spending $31 to buy the 1800, which is basically the time that these went up is midday, which is where I kind of took the strikes for some of these examples. But basically right at the money. They're buying at the money calls, and they've done this now, I would say 2 or 3 times in the last 5 weeks maybe, and it's worked for them pretty well. So the issue that I have is, number one, so this is like, it's a short-term trade, but it's more than a day trade, right? So it's not just flipping around Amazon for a day trade, which I think is very risky. I think any type of day trade is kind of difficult, right? You see people talk about it on Twitter, but you never really see them, basically share their entries and their exits and so forth, and they basically will just talk about levels, up in the air. Oh, this is where it was marking. Oh, I got in a couple hours ago. In reality, it's a lot harder than that to day trade Amazon. It's a lot of money, right? To me, $3,100, or even if you go out of the money a little bit and spend, let's say, $2,000 a contract, that's a lot. And you really have to keep your eyes on this at all times, because I think that's a lot of money to spend just and literally on one contract. If you only buy one contract because you don't want to spend more than $2,000 per short-term trade, which I kind of agree with. I think that's a lot of money to spend on a very short-term trade. How are you going to take targets? So you really have to spend, in my opinion, to take targets, which I think works really well for short-term option trading or just option trading in general. You're going to spend $10,000 on or something like that to trade Amazon short-term. That's too much to me. That's too much money to risk. So when I trade options in Amazon short-term, when I'm looking at these options that hit the tape, I usually do it via call spread. Why? Because it's less money, and so I'm not committing as much capital, and also I'm kind of defining where I think it can go on the chart, right? So I'm not just saying, I think that's part of the mistake that some option traders make, is they're like, oh, I just think it's going to go higher, right? Well, where do you think it's going to go? I will only kind of take one of these trades, and it's kind of the formula that I use when I see option activity on the tape is, okay, well, it's got to set up pretty nice for me technically, and I got to think about, before I even get into the trade, how much I'm willing to lose if it doesn't work out, and where I think the name could possibly get to into the chart. So before we even go into the strategy, again, I'll try to keep this video short. I know it's a complicated strategy, but it's breaking out of a nice little flag pattern, and maybe it can continue to run up here a couple of days. Had a nice day today, up 1.9%, right? So I think now is a good day to kind of watch this, right? I mean, this had a nice run, then it consolidated for a week and a half. So you have to ask yourself too, do you think this thing is going to burst right out, or do you think it's going to be, kind of a grinding move? Now, so I've got 2 different alternatives depending on what you think is going to happen here. Also, if we look at the weekly chart, because I like to look at this as well. Well, that's the monthly. But I also like to see what's going on in the weekly chart. Notice we're above resistance as well. We're above 1772, which I think was resistance for Amazon. So my directional bias for Amazon is long right now. I think it's just starting to move up a little bit. So how do I get involved in a short-term option play? Because again, this name is going to be reporting mid-April, and I certainly do not want to put on a trade that has to deal with earnings or mess around with earnings. So I want a trade that is going to expire before their earnings date, which I think is around the 24th of April. It doesn't matter because we're only going out to the April 12th, which is way in front of that. So let's go back. So again, my bias is to the upside, right? My direction is to the upside, and I think the charts are supporting that after the digestion. I don't want to play outright calls. What I want to do instead, because again, it's too much risk, is I want to buy a call spread. And I could use the same maturity that they're doing, right? I want to kind of match. Again, I don't know what they've got. So again, same thing when I said where I think option traders go wrong. I don't know their motivation. They could be hedging something. They could be doing. Now, I think this was an aggressive trade, but again, they could decide to hedge this tomorrow, and that's not going to be what I'm going to be doing, unless it really works that way. So that's all. You have to go on your own strategy. Once you see this on the tape, forget it. Somebody's positioning gives you an idea. Now you formulate your own trade. All right. So. And again, of course, this video is for information purposes only. I'm not giving out any recommendations. This is just a sample trade. But what I like to do is I'll buy a call spread the same maturity. So notice I'm picking different strikes, right? They're going to 1800. I want to go a little bit out of the money. So again, this is my own strategy. So I'm looking at 1822. It's a level that I think, first of all, we have to get outside of value. So that might hinder this a couple days. I'm not sure. I don't have a crystal ball. But again, I'm biased to the long side. I think 1822 is something you could get to, even up to 1850. So what I did was I actually cut it. Now, the wider that you make the spread, the more that you're gonna have to commit. So what I like to do is look at how much I have to spend. So this is a $1750 wide spread, right? So the most I can make. So let's talk about, first of all, you should always focus on, or I should always focus on, again, not giving any advice, but I always want to focus on what could I possibly lose. Then we'll talk about the reward. But you always want to start with how much you could lose, right? Most I could lose is the premium that I'm spending. So what I'm paying for the option of this trade is $650, or per contract $650. That's my total loss that I can make. That gives me the ability to make the distance between the spreads, which is $1,750, right? And then, of course, you have to back out what you're paying. Of course, and there's commissions involved too. But that's basically a little over $1,000 a contract. Again, complete max if it happens to close above 1840 on April 12th expiration. Do I let that happen? No. I mean, what I'm looking for realistically is if I get into a trade for 650, if I can get out, probably take a target at around 850 or 9, and then maybe a target at 11 or 12, somewhere around a double, and then maybe let the last piece run maybe for the ultimate. So again, you have to have, in my opinion, going back to the $3,100 to spend for a contract, I would like to take probably 3 targets in this trade. So it may be a 3 contract type trade, something like that, risking around $1,800, or maybe a 2 lot. We'll see. This can also be adjusted as you go along because you've got 9 days at this point to option expiration, and different things are gonna happen. But always important to map out what the most you can lose, the most that you gain, and then you could see if it makes sense from a risk to reward standpoint. Okay, so that's basically a fine trade, and you can do that. You could also do something where if you're really bullish, you could sell a put spread too. I'm not going to get into that. This is a strategy so I've been doing this strategy for a long time. The wrinkle in this is the second alternative, and which I've been kind of testing on my own. But again, it depends on what you think is going to happen. If you think you're going to get a couple choppy days with Amazon, what you can kind of do is you can kind of lean into this trade a little bit to try to reduce your 650, right? In case it doesn't work, what you could do, and let's say that you, for simplistic purposes, you start this trade off with two contracts, right? So you've got two pieces on, and your risk is what, $1,300, right, for the whole trade, which I don't have spelled out here, but that's okay. What you could do as well is you could sell a little bit of front month, or not front month. This is front, should be sell front week. Right, so options that expire this week, 4 or 5, and you could do the same strike if you like. Now, again, this is the price has moved. I did this when Amazon was trading at 1,800. Now it's trading at 1,814, so a little bit different. But you could take the same strike, the same beginning strike, and instead of making it 17, because again, that's your return. The max that you can make is the 1750. What you could do is kind of cut that down a little bit. So it's only 1822 and a half, 1830. Why do I do it like this? This way you're not jeopardizing your return. If Amazon happens to fly through the roof really quickly, the most I could lose on this trade, again, we'll start with the loss. Now again, this is a credit spread, right? So you're collecting the $3. You're selling the 822, buying the 1830. This is the opposite here, right? Here you're going long the 1825 and selling the 1840. This, you're doing the opposite. And you're doing this in shorter maturity. So again, more of a trade if you think it's just going to be a slow move, slow grind for Amazon. And you could sell that contract for $3. What's your maximum loss? Your maximum loss would be per contract, $450, right? So that's in case it blows all the way through the upper strike very quickly, and you're discounting what you're collecting on the initiation of the trade. So $3 minus the 750, that would be your loss, right, per this contract. The maximum profit is the premium that you're collecting. That would happen if holding all the way to Friday and Amazon closing, let's say at 1820 or anything below 1822 and a half. But I have an asterisk on there. I'm not really going to hold this till Friday's expiration. What my plan would be is to not get greedy on both sides, right? So if let's say Amazon, so let's say you put this trade on for today. And again, I would not, I would make sure that your contract sizes are uneven, right? So if I bought two of these, the long call spread, the debit spread, then I'm going to only sell one of these, right? Because this way, no matter what, if Amazon rips, I'm still going to make money. Right, and again, they're different maturities, so this is not going to be, even if it goes through 1840, it's not going to realize the full 1750 because you have time value against you if it happens in a day or two. But you will still make money on it, right? So again, you would do this two and one, so it's kind of like a two by one, or 1 by 2, but two by 1. We'll say it that way. Again, a little bit different than what you normally know is that, but we'll just leave it there. So that's here. Again, difficult. This is kind of difficult to explain. But what you want to do now, optimally, you could do this a couple different times. So let's say that you put this trade on today, right? Today's Monday, the 1st, and you're collecting $3. Tomorrow you come in, for whatever reason, the market starts down on the day. We start down, the S&P starts down 30, 40 basis points, and Amazon opens up at 1790. What's going to be the value of this contract? It's probably going to depreciate, and it's only going to be worth maybe, $2 or $1.80, right? You could go ahead and cover that, and you can make $120. Now, you've just reduced your maximum loss of this contract, right, by 120. So again, you're not going to be greedy. You're not going to try to collect this $3 all the way to expiration. You're just going to try to kind of make a little bit of money on it. And then, because ultimately what your objective for, in these structures, you always want to remember why you're doing the trade in the first place. Do you think Amazon's going to go higher? So if you get that short-term dip at some point this week, you could go ahead and cover your short spread. And then once you do that, then you can make an adjustment here if you want to. If this contract goes down from 650, which you originally paid, and it decreases by the same amount that this went down, right? So now maybe it's only worth $5 or something like that. You could decide if you want to add to that, right? And then you could kind of play a little bit of a game and maybe wait for Amazon. Let's say that on, let's say on Tuesday that happens with Amazon, and this contract goes down to, let's say, $2 or $1.80, right? You could cover this, and then you could wait for Amazon to rally again, and you could do this trade again all over, right? Because you're still long the two contracts. You've covered your short, but you're giving yourself the ability that if Amazon rallies again, you could even change the strikes up a bit, right? So it gives you a lot of flexibility. And again, the reason why I like it so much too is because you're not going to eat away, even if Amazon does what you want it to right away. You're not going to negate all of your profits on the trade because you're longer than you are short. All right, so that's a quick trade. Now, if you have questions about this, it's more of kind of a put the trade on, put it on in small size, test it out, and then as you're going along, watch how it behaves. And again, you could do a lot of adjustments with this trade. You don't have to do it right on Monday. You could also do this trade on a Tuesday or Wednesday. You could wait until, because sometimes what I do is I put the first trade on. I put the long call spread on first, and if I happen to get lucky and the trade starts to move in my direction, then I wait and do that short call spread once the stock's a little bit higher. Right? You're giving yourself even more of a buffer. All right, so that's enough. That's a 15-minute video. It's a long video to explain one structure, but that's what we're up to, and I think it's a good way to try to get involved in Amazon, a high-price stock. The options are a little bit difficult because they are they cost a lot. It costs a lot to get into Amazon. That's the way I play it, and it's worked pretty well for me. If you have any questions, you can hit me up in the room. Thanks for watching. Have a great night.